3,147s for at first glance it sounds like a typo, or a headline engineered to break the internet. But according to the data in this document, that number didn't come from hype. It came from a chain of ratios, debt, gold reserves, historical precedents, stacked together into one explosive projection. And once you unpack the math step by step, the shock shifts. The real debate isn't the arithmetic. It's the assumptions behind it. Let's zoom out. During World War II, US federal debt ballooned. Yet at the peak of that expansion, roughly 50% of that debt was backed by gold reserves. Half of what the government owed had a metallic anchor behind it. That structure helped stabilize confidence during the most expensive war in human history. Now fast forward. Today, federal debt relative to the economy is even larger, but gold backing has collapsed from 51% to roughly 3%. The US still holds 261.5 million ounces of gold. The metal hasn't disappeared. The debt has simply grown around it. Same vault, much bigger liability stack. Pause for a second. In 1980, the gold-to-debt percentage jumped back to 18%. Not because the US bought more gold, but because gold's price surged during the 1970s. The asset repriced itself against expanding debt. That's the critical mechanism here. Now here's where the $3,947 figure begins to form. If US gold reserves were revalued to cover 51% of today's federal debt, matching the World War II benchmark, the total reserve value would need to be roughly $20 trillion. Divide $20 trillion by 261.5 million ounces, and you get approximately $75,000 per ounce of gold. Yes, $75,000 gold, and if you apply a gold-to-silver ratio of 19 to that gold price, silver calculates to $3,047. That's the viral number. The arithmetic checks out. $20 trillion divided by 261.5 million ounces equals roughly $75,000. A ratio of 19 has occurred before in history. On paper, the framework is internally consistent. But here's the real question: does 51% debt backing ever return? Probably not. The global system runs on fiat currency and central bank credibility, not vault audits. Using 51% is the most aggressive baseline possible. Now reset your focus. What happens if you cut that assumption down? If backing rose to 25% instead of 51%, gold would need to sit near $37,000. At 18%, the 1980 level, gold lands around $26,000. Even at just 10%, gold would need roughly $15,000 per ounce. Different assumptions, same directional pressure. So the conversation isn't, is $3,947 inevitable? It's, how much repricing does history suggest? Because historically, when debt stress builds, gold closes at least part of that gap. And that brings us to the second ratio, the one compressing in plain sight right now. There's a chart that compresses 100 years of market psychology into a single line. And right now, it's flashing the same signal it did before the biggest gold run in modern history. It's the Dow divided by gold. When the Dow-to-gold ratio is high, stocks dominate. When it falls, gold outperforms. Simple concept, massive implications. The ratio peaked in 1929. Then it collapsed into 1933. It surged again into 1966, then fell into 1980. It hit an all-time high of 44.8 in 1999. Since then, it's been trending downward, with one failed rally in between. Today, the Dow-to-gold ratio sits at 985. Let that sink in. In 1973, right before gold's historic run from 180 to 850, the ratio was roughly the same, around 10. From there, it fell all the way to 1 by 1980. That collapse in the ratio reflected a 4.5 move in gold. Patterns don't guarantee outcomes, but they demand attention. Now here's the framework described in the source material. Instead of targeting an extreme ratio of 1, the projection uses 2.5 as a midpoint target. Not the bottom, the middle of the move. If the Dow stays near 49,500 and the ratio drops to 2.5, that implies a gold price of roughly 19,800. The math is mechanical. 49,500 divided by 2.5 equals 19,800. Take a breath. What if the ratio only falls to 5? That would place gold near 9,900, call it 10,000. If it drops to 3.5, gold lands around 14,000. Different endpoints, same trajectory. Here's why this matters to you. Every prior cycle where the Dow to gold ratio became stretched eventually resolved through gold outperforming equities. In the 1970s, the Dow was mostly flat while gold surged. Stocks didn't need to crash. Gold just needed to rise faster. And consider this. In past cycles, the ratio bottomed when debt burdens were neutralized. In the 1930s, deflation crushed liabilities. In the 1970s, inflation eroded them. Today, debt hasn't been extinguished. It has expanded, which suggests something critical. If the true bottom in this cycle wasn't set in 2011, then what we're witnessing isn't a new bull market. It's the continuation of a cycle that began in 1999 and hasn't finished. That reframes everything. Because if gold moves toward 19,800, even as a midpoint scenario, the ripple effect on silver becomes impossible to ignore. And this is where the model gets controversial, because the next ratio, gold versus silver, is where optimism turns into debate. Now we enter the volatile zone. Gold and silver don't just move together. They stretch and snap against each other through a ratio that has defined every major metal cycle for decades. Right now, gold is above 5,100 and silver is above 84. That puts the current gold-to-silver ratio at roughly 60.7. A few weeks ago, when gold was at 5,042 and silver at 77, the ratio sat near 65. It's already compressing. That compression is the ignition point. In March 2020, during the panic crash, the ratio exploded to 125. In January 1980, at the peak of the last great metals mania, it collapsed to 14. Massive swings, same two metals. The projection that generated headlines uses 19 as the target ratio. Not 14, the historical extreme, but 19. According to the framework in the source material, that level is considered conservative relative to the 1980 low. Here's the mechanical outcome. If gold reaches 19,800 and the ratio falls to 19, silver calculates to $1,042. That's the aggressive scenario. But this is where intelligent disagreement enters. A ratio ACE of 19 has only appeared once in the last 50 years, during 1980, when extraordinary speculation distorted the silver market. Before that, you'd have to go back to eras when silver functioned as a circulating monetary metal. Today, silver is primarily industrial. Central banks buy gold. They do not buy. That distinction matters. Reset your perspective. In the 1970s bull market, before extreme distortions, the ratio moved into the 30 to 35 range. In 2011, it reached roughly 31. That zone appears more natural during metals expansions without speculative mania. So let's adjust one assumption. Gold at 19,800, ratio at 35, silver equals 566 hours, still dramatic. Try a midpoint. Gold 19,800, ratio 25, silver equals 792 hours, or dial gold down to 15,000 and keep a ratio of 35. Silver still equals 420 hours. Notice something powerful. Even when assumptions are deliberately restrained, lower gold target, higher ratio, silver repeatedly lands above $400. That's nearly 5x from 84. The moderate scenario approaches 7x. The optimistic case pushes toward 10x or more. You don't need 3,947 to change your financial life. You need ratios to revert. Historically, they always have. Now pause here, because bulls often stop the analysis at upside projections, but serious investors go further. They ask what could break the thesis, and the counter-arguments are not trivial. Because the next challenge isn't about ratios, it's about supply and whether higher prices simply create more silver, capping the move before it ever reaches those projections. Here's the pushback you'll hear immediately. Silver is a commodity. If prices rise, miners produce more. More supply pushes prices back down. End of story. It sounds logical. In normal markets, that mechanism works, but history complicates it. In the 1970s, gold moved from $35 to $850. That's a 24x expansion. Silver climbed from under $2 to 50 ans, a 25x move. Mining activity did increase during that decade, yet supply never caught up fast enough to stop the surge. Why? Because bringing new supply online isn't instant. Opening a new mine typically takes 7 to 10 years. Expanding an existing operation can take 3 to 5 years. Demand spikes fast, supply responds slowly. That lag matters. Now consider what's happening today, based on the data described in the source material. Silver has been in a supply deficit for 5 consecutive years. Prices have tripled, yet shortages persist. Refineries are reportedly backed up until April. Mints are limiting orders. A major bullion dealer in Singapore described 8-hour queues. COMEX vaults are draining at 20 million ounces per month. If higher prices automatically solved the supply problem, it would already be solved. It isn't. Reset the lens. The second criticism is that silver isn't a monetary metal anymore. Central banks buy gold, about 2,500 tons a year. They don't accumulate. Therefore, silver lacks sovereign demand. That's partially true, but rewind to 1971. The United States had just left the gold standard. Gold was being demonetized. Central banks were sellers, not buyers. And yet gold still moved 24x over the following decade. Silver still surged 25x. The driver wasn't central bank accumulation. It was debt stress, inflation, and declining confidence in currency systems. Sound familiar? And silver's role today isn't trivial. It has been added to the critical minerals list in the United States. That designation isn't symbolic. It reflects industrial and strategic importance. Solar panels, electronics, medical systems, defense technologies. Industrial demand is growing, not shrinking. Now imagine something else. Central banks are not buying silver today, but what if they ever do? Even a modest sovereign bid entering a relatively small market could compress the gold-to-silver ratio faster than models anticipate. The absence of that buyer is not permanent weakness. It's potential energy. But before we get carried away, we need to talk risk. Because every thesis breaks somewhere. And understanding where this one could fail is the difference between conviction, and blind optimism. And that's where the real strategic thinking begins. Before you anchor to any target, 400, 800, 1042, or the headline-grabbing 3147, you need to stress test the thesis. Because markets don't reward belief, they reward correct positioning. Risk number 1, governments regain control of debt without a currency crisis. If deficits shrink, spending tightens, and debt to GDP stabilizes without triggering systemic instability, the pressure for gold to reprice weakens. It's difficult to imagine in the current political climate, but it's not impossible. Reset your thinking. Risk number 2, a severe global recession. In 2008, gold initially fell. Silver was hit even harder. In a liquidity crunch, investors sell what they can, not what they want to. A sharp deflationary shock could temporarily crush metals before any long-term repricing unfolds. Risk number 3, technological substitution. If silver demand from solar panels or electronics is disrupted by a cheaper, scalable alternative, the industrial demand pillar weakens. There's no immediate evidence of this happening, but ignoring the possibility would be naive. Now shift back to the core. The directional case remains compelling. Gold appears deeply discounted relative to debt metrics. The Dow to gold ratio, currently 9.85, mirrors prior launch points like 1973. If it trends toward 2.5, with the Dow near 49,500, gold projects near 19,800. Even if the ratio only moves to 5, gold approaches 10,000. Layer on, using a gold target of 19,800 and a ratio of 35 yields. 566 at 25, it's 790 tillers. Even a toned-down gold price of 15,000 with a 35 ratio produces 420 yards. These are not fantasy combinations, they're moderate inputs. And here's what matters to you. Silver above 84 today. At 400, that's nearly a 5x move. At 600, roughly 7x. At 1,000, close to 12x. A 10,000 position transforms dramatically under those scenarios. You don't need 3,147 to alter your financial trajectory. Zoom out. The entire above-ground silver market is valued around $200 billion at current prices. Global debt exceeds $300 trillion. That's roughly a 1,500 to 1 imbalance. When even a fraction of debt repricing shifts toward hard assets, percentage gains aren't incremental, they're exponential. And timelines matter. The projection described points toward 2030 to 2033, echoing the roughly 7-year arc seen in the 1970s cycle. This isn't a next quarter thesis, it's structural, final reset. Two ratios, Dow to gold and gold to silver, are stretched. Both have reverted in every prior cycle across 100 years. If they partially revert again, silver's upside extends far beyond what most consider reasonable today. The question isn't whether silver is undervalued relative to history. The question is how much of that historical pattern repeats, and whether you position before it becomes obvious. Drop your view in the comments, conservative target or aggressive. And if this breakdown clarified the math, subscribe and stay plugged in. Because when short-term supply tension meets long-term ratio compression, moves don't whisper. They accelerate, and the next phase may already be underway.